Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello and welcome to India Market Outlook podcast mini-series, which outlines the key investment views and how investors should be positioned in the current market scenario. My name is Ravi Singh and I'll be your host for this podcast. Today, I'm joined by my colleague, Mr. Manpreet Gill, Chief Investment Officer for Standard Chartered Bank, Middle East, Africa and Europe. Welcome to our podcast, Manpreet.
Hi, Ravi. Thanks so much for having me on.
Great to have you here. Well, just getting started with the first question. We started the year with the theme of sailing with the wind, and now we have adapting to shifting winds. So what has changed so far, and where do we see opportunities in the second half of 2024?
Well, I think that's a great question, because you're right. At the start of the year, when we laid out the theme of sailing with the wind, we had noted that we'd have to adapt if the wind started to change direction. And in a few areas, they arguably have started to do so. And perhaps this is most visible in central banks. Start the year, we were still talking about central banks cutting rates, but now by the mid of the year, we've started to see some of them come through. So that started in Europe. It started with the Swiss National Bank, and the European Central Bank, of course, followed suit. The big one, of course, will be the US Fed. And I think we started to get some signals that they're willing to consider rate cuts later in the second half of this year, possibly in September. And that, of course, we think will mark a significant inflection point for global markets, because it means central bankers are having to stop focusing on inflation alone and now room to really consider supporting growth. So I think that's one big inflection point where we're adapting to. And the second is, of course, at a global level, at least in many of our polls, we started to narrow our views a little bit. So while we still like equities over bonds and cash, we have narrowed our preference to the US from a regional perspective amongst major regions, and of course Indian markets within Asia on the equity side. And outside of that, of course, looking more for pockets of opportunity in bonds, where, given what I just talked about on the central bank side, we think it's really about starting to lock in bond yields in US dollars before they start to move lower. So a few things to adapt to, but we think those are really the big shifts.
Well, thanks, Manpreet. Now, talking of adapting to shifting winds, 2024 had an unusually busy election calendar, and we've seen quite a few surprises on the way. Now, the next big one, of course, is the US election, which seems to be developing into an interesting one. How do you see that impacting markets?
So US elections, yes, I think they're perhaps the most significant one coming through in November. And your time horizon does matter here. I'd start by saying that when you go back and look at elections, in history, and we went back all the way to 1928, elections can be a source of volatility in the days and weeks around the election themselves. But actually, when you start to extend the time horizon out longer than that, out to 6 months or longer, it's actually quite hard to discern the impact of the election alone. So on average, at least, I wouldn't overstate the impact of an election, beyond, of course, creating opportunities through volatility. But having said that, you're right. I think this election, of course, is turning out to be quite an interesting one. And look, we're still 4 months away. And as we're learning, a lot can change in US politics in 4 months. I think from a market or an investor perspective, I think the one thing worth considering is, the implications of a Trump victory, which is what markets are pricing at the moment. Because there are some concerns that Trump's policies, which is, got more tariffs, more spending, are ultimately more inflationary on the margin. So that's, I think, one concern that's out there. From a bond yield perspective, though, we're less concerned. We still think the central bank move towards cutting rates and economic growth, those will ultimately dominate, perhaps putting a higher floor on bond yields than would otherwise have been the case. From an equity market perspective, though, I think the conversation on tariffs will be quite important, because depending on how they're applied and whether some regions or sectors are taxed higher than elsewhere, those of course could create some sector-specific challenges. So something to keep a watch on, but I think something we also have to wait for more details.
Thanks, Manpreet. Now, coming closer to home, India has been a strong macro play, and that is also, at least for the last few years, and it is also reflected in how Indian assets have performed. How do foreign investors see India as a market?
So from a foreign investor perspective, India is still very much a bright spot. And I think that applies regardless of whether you're a stock or a bond investor. Now, from an equity perspective, like I said, we're overweight Indian equities relative to other Asian markets. And what that really speaks to is obviously the positive macro story, think macroeconomic growth, of course, India is still one of the strongest growing economies, but that also translates into expectations of, positive earnings growth. And while some of those might mean revert over time, there's, relative to the other options in the emerging market space, that would still sort of put Indian equities at a good place. And valuations, no doubt, are a challenge, but we think the high return on equity and that positive growth picture, for the time being at least, outweigh the valuations challenge. Bonds, of course, actually from a global investor's perspective, are, if anything, even more topical and interesting today. So we do like, Indian local currency bonds. I think the big catalyst, of course, is the index inclusion, that inclusion in major benchmarks. And we think that's important because it creates a tailwind of a regular series of flows that we think, can support particularly medium and long duration bonds. And of course, over and above that, from a global investor's perspective, they do offer an interesting yield pickup over the rest of the emerging market universe, at least on the local currency front. So that combination, we think, is quite attractive on the bonds front as well. So it's not just an equity story.
Well, no, that was more from a global investor standpoint. Domestic risk assets have rallied strongly in the first half at least. How should investors position for the rest of the year?
Well, onshore, we think it's about taking a much more balanced stance between equities and bonds. So we have a neutral or a core holding view on equities, onshore equities, and on onshore bonds. And that's not to say that equities are not attractive, right? We just talked about how we think they're attractive relative to other Asian markets from a global context. But in India, of course, bond yields are higher. And that, of course, imposes a higher bar for equities to beat. So from an equities perspective, look, I think the earnings story, of course, is still important. Of course, as we discussed, some amount of mean reversion, is likely to occur. But this is where, of course, the policymaking environment is also something to watch, because we have completed elections, we have the budget, which is most probably that's due tomorrow. So many of you might have already know about it by the time you listen to this. But these, of course, could help broaden the policy focus a little bit. And from a sector perspective, especially, that can be quite important. But bonds, of course, we think, equally important, because the yield itself, of course, we think at an attractive level. But, similar to what we discussed at a global cycle, if bond yields start to move lower, or the central bank, at some point starts to consider rate cuts, of course, medium to long duration bonds should benefit from that. That's the segment we like. But also the tailwind from, investor inflows from bond inclusion. We think that, of course, can impose a steady tailwind, which should benefit the medium to long duration bonds in particular. So as far as onshore, assets and our onshore portfolio, we think it's about, taking a balance to what we find attractive on both the equities and the bond side.
Well, we've talked about opportunities and some shifts in winds. What are some of the risks that investors should brace for? As history suggests, over the last 4 years, every year we've had one or the other challenges. Anything that you think that investors should prepare and be watchful of?
Well, I think the thing with risks is there's almost always a long list of things to worry about at any point in time. But I think today, at this particular point in time, there are a few that stand out. So maybe two on the global side are, one, of course, is the US economy. And I'm specifically talking about the US labor market, because while our expectation, of course, is the US economy achieves a soft landing, so growth slows but stays positive, I think the labor market is quite key to watching whether that becomes a bigger risk and growth, and how big a risk the US economy is from at the risk of turning into the negative side and a hard landing. The second one, of course, is oil prices, because from a geopolitical perspective, the world is certainly not calm at the moment, and one always has to be on watch for risk that the conflict in the Middle East starts to spread, because the channel to markets in such a scenario, of course, would be through oil prices. And besides, of course, the shock that we know it historically can create to the global economy, for India's economy in particular, it would put some of the improvement we've seen on the external and fiscal side, at risk under a scenario where oil prices spike because of a geopolitical event. Onshore, of course, we always had the steady stream of state elections. So from a policy perspective, especially given what we just discussed, that's something to monitor. But I'd also keep a watch on the US dollar, because for a lot of the India equity and bond side, the fact that the rupee has been quite stable has definitely been a positive. But that means it's something we need to keep an eye on, particularly if it's a global event that triggers a bout of dollar strength. That, of course, can have a negative impact on many EM currencies, including the rupee. So all risks, not our base case scenarios, but these are the things, I guess, that keep me awake at night.
Thanks a lot, Manpreet, for being on the podcast. You've articulated the views quite well, and also some of the risks to watch for. that's all the time we have for on a podcast today. Thank you as always for listening. And if you enjoyed this podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.